Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. And guys, good morning.
Morning.
Somehow, it doesn't look like we are coming out of a holiday, right? It just looks continuous. Like It never ended. We never went anywhere. We were right here because markets are doing exactly that.
I was wondering, Prashant, what you've been up to between Besant and Navarro and Hesset and Trump and then Musk is saying something and someone's speaking on CNBC, someone's speaking on CNN. I gave up trying to follow beyond the point. Prashant is our man. He'll keep us up to speed on everything that's happening on that roller coaster.
Well, that's right. And at least with all the cues that we've got, at least a positive start is what we could brace ourselves for. And it'll get very, very interesting from there.
And Surabhi, we were talking about today's Friday, right?
Yeah.
So Wednesday morning, the last day, we were talking about
one headline away from things turning.
Yeah. No, I was talking about the bond market thing.
Yeah.
Which we started discussing at about 9 o'clock.
Because the yield had shot up to about 4.5.
I think it was about 9 o'clock, 9:05.
9:30 when it was midnight and those tariffs hit, suddenly markets
9:30,
were 9:30. They started moving, big time.
That is essentially what has caused this. Apparently, that is what has caused this U-turn, this pullback, back from the brink, or whatever you want to call it. But it's not all settled. And I think that's the important point which we will take forward, because it's all incremental. I mean, unless you've been living under a rock, you know that the sort of tariffs have been paused for 90 days for all countries except China. So let me just quickly recap things, just a change, right, on the equity indices and macro markets over the last 2 days, because we'll be reacting to US on Wednesday and US last night as well. So the S&P is up 6%. These numbers look much bigger if you were looking at them yesterday morning, but we were not around yesterday morning because indices rallied 10, 12, 13%. But last night they gave up 4, 5%. So this is the net change. S&P 6%, NASDAQ about 7.85%. The CBOE VIX, came off very sharply. I think it fell 35% the previous day. Yesterday it went up some 20%. So the net change is minus 15. The CBOE VIX. And the other markets, right? The 10-year yield is up 12 basis points. You have the dollar index, which is down about 2.3%. And Brent prices, again, have seen, 4% swings, 3% swings. So that's 1.7% net change higher in terms of the reaction that we've seen. Now, before I get into some of the other stuff which I think is relevant from here on. So the net change is positive. So you will get that reaction today, and the market will look a little better as compared to where we left off on Wednesday, because you're going to be reacting to 5-6% changes net over the last 2 days to US equity indices. But I think the bigger story, and this is the reason why what gives people is giving people a lot of cause for worry, and why people are saying we are still in a flux, is the bond market, and this quote should come up. Which I think is very instructive. I mean, it's not from now. It's basically back from, the GFC, the global financial crisis. Timothy Geithner, if you remember, was the U.S. Treasury Secretary from 2009 to 2013. And, this is what he said. I used to think that if there was reincarnation, I wanted to come back as the president or the pope. But now I think I'd much rather come back as the bond market. You can intimidate everybody. And I think that very, clearly and in a very pointed way tells you what really happened. So let me just quickly run you through that, right? So Trump basically did acknowledge, and we don't have to go by hearsay or, by kind of sort of trying to interpret things. He very much clearly, the graphics will come up. He said, the bond market is very tricky. I was watching it. I saw last night where people were getting a little queasy. Not the most eloquent way to describe what was happening in the bond market, but he acknowledged it in his own way, that it was the bond market which forced him to pull back at the last minute. And of course, maybe, discussions with Secretary Besant, who's a market veteran, etc. So this is very clearly the issue. Bond yields were ripping higher. And the issue is this: in times of risk off, when equities are selling off and there is stress generally, yields should bonds are a source of safety, especially U.S. treasuries are a safe haven. But they did not act like a safe haven. they were actually, yields were higher and they were going higher and higher and prices were falling, which is not what should be happening. And I think this is the basic underlying worry. You also had comments from, Federal Reserve representative, disruptions, and this is from last night, by the way, disruptions in Treasury market were instructive, watching Treasury market minute by minute. So this is from last night. Now, US bond markets are still very much in focus, as we speak. That is because over the last 2 days, Wednesday and then yesterday, you have had two successful auctions. One in the 10-year, the second is the 30-year tenor. So two successful auctions. What should yields do? Yields should fall, right? Well, what has happened? Yields are higher, especially on the long end. If you look at the 30-year yield, it's up 13 basis points last night, and we are very close to 5%. I mean, so that is not falling. And I think this is essentially basically the issue. Now the fundamentals. U.S. growth concerns are still intact. The effective average tariff rate 2 days back was 25%, right? Pre-Trump, when Trump came into office, it was 2.3. It went to 25 as he kind of sort of attacked everybody. He's pulled back from everywhere except China. The effective tariff rate is still 20. It was just 25 72 hours ago. So these growth concerns are still there. Many global banks still have a recession forecast. The odds are they've brought a little lower. And of course, US and China are moving into a full-blown trade war. It's 145%, by the way, on China in terms of tariffs, which Trump clarified. And of course, will there be reconciliation? Hopefully there will be. On Wednesday, I was saying perhaps it's a 10-12-day problem and this will get resolved. Will the same happen with China? Hopefully, fingers crossed, yes. So Trump essentially has said that, a phone call will happen at some point and we'll be off to the races, his comments. But he's also promised at the same time tariffs on pharma, semiconductors, agriculture, etc. But I think generally the sting has gone away, especially with regards to tariffs, because he tried something and it didn't quite work out as he thought it would. So just to circle in the levels, the levels here. So the Nifty 40-hourly exponential moving average is 22,642. That's about 250 points away from where we are. But beyond that, the upside level for the Nifty is 22,806, which is and then 23,057. I put these levels on Friday. These are not moving averages, so they don't change their retracement levels. And that's the 50 and the 61.8% retracement of the fall. The Bank Nifty resistance, similarly, is the 61.8% retracement, which we almost got to on Tuesday. 50,848 is that number. And then after that, the swing high comes in, which is 52,063. So that's the picture. GIFT Nifty will come up on your screen effectively it'll tell you how we are likely to start. It's 460 points on the GIFT Nifty compared to Wednesday's close. Surabhi.
Prashant, you're saying queasy. Queasy is a proper word. It's an English word. I went back and heard that soundbite so many times because I couldn't believe that's how he's describing it. He's saying people in the bond market, they were getting a little yippee. Yippee. So, I don't know. I've heard yippee with a very different connotation up until, Thursday. Yeah. Thursday morning. So, yippee was what perhaps made him change. Anyway, let's talk about the reaction that we're getting across Asia. The markets now here, because we had the fall overnight and the fact that US futures are lower, markets across Asia have resumed a bit of their slide. So Japan surged 9% yesterday on the pause. This morning, it's down 5%. So it's given off a little more than half of that gain. If I look at some of the other regional markets as well, the Australian markets are down about 2.5%. Let's look at what's happening across Hong Kong. Hong Kong slightly lower, 0.7% lower. Shanghai is, on its own path. Shanghai is actually, flat, which makes it right now the best performing market. It's not falling too much. Others are down. Singapore is down about 2%. South Korea is down. All those markets are down quite a bit. Okay, now beyond that, we have to look at where the final sort of numbers lie. What we know as of now is the tariff levy is 145% on China. On autos, aluminum and goods which are not part of the US, Canada and Mexico trade agreement, the tariffs remain at 25%. And for the rest of the world, including for us here in India, the tariff now is at 10%, and this 90-day window has opened up for negotiation. By the way, the EU, because of this 90-day pause, the EU also decided to halt its retaliatory strike. The EU had, geared up with slightly higher tariffs on specific targeted products, but they've held off from it for another 90 days as well. What's interesting is that in all of this, between last night and this morning, gold has surged. The dollar has absolutely nosedived. The dollar index is, look at that, just about 100. And gold continues to charge higher. There's simply no stopping it. levels of 3,200 plus on the precious metal. Now, where are we in this entire market fall? Just to put this crazy April in context so far, we're down about 5.5% at the headline level, index level. Nifty is down 4.7, mid-cap is down 4, small-cap index is down a little over 5, and it's the global-facing sectors, metals and IT, they've taken it on the chin. Look at the cuts there already so far, not even halfway through April, and we're down 13.7% on the metals index and about 12% on the IT index. Will this stop? Will this slide stop or not? Let's talk about the fund flows. Well, that's not where we're getting any help because FPIs have been continuous sellers so far in April. Even on the previous trading session, they went ahead and sold equities to the tune of about 4,300 crores. There was, some support from domestic institutions, about 3,000 crores of buying coming in from DIIs. Speaking of DII flows today, it's the mutual fund data. So that's important, very important to watch because in February, we saw the first sign of skittishness. The February net equity inflows were down 25% over January, and there was a lot of money moving out of mid-caps and small-caps. So let's see if that trend continued in March or whether it was arrested or not. Finally, obviously, we'll spend a fair bit of time talking about TCS today. I'll tell you the headline. I mean, there's nothing really exciting out there. The numbers are slightly, just a shade below, very muted expectations. So what do we have? We have dollar revenue declining 1%. Constant currency growth at 2.5% is the lowest TCS has delivered in the last 4 quarters, lowest of FY25. On this whole tariff storm, what the company has said so far in the press conference, and of course we'll get more specific commentary, they're saying they haven't seen any major project cancellations, but there are some ramp downs and delays in decision making. Obviously, the company's margins have also, come out lower than expectations. And so far, no announcement of a wage hike. They're saying they'll do it, but they've just deferred it. They'll decide on it in a bit. So TCS is slightly negative Q this morning. Nigel.
Well, today, I think the big Q is not where we're going to start because everyone knows we're going to be starting off in the green. The question is, where do we end? And that's going to be the key factor for today's trade itself. We look at the Troika, and 2 out of the 3 are well behaved. The dollar index is very, very weak. The Brent crude prices are lower. Both those 2 are Indian market positive. However, the bond yields have spiked up, and that's a bit of a worry. It's a menace not only for President Trump and his plan, because otherwise the plan was working out perfectly. Yields had come down to around 4% or thereabouts. Then he had to rethink, and this is a bit of a menace for equities as an asset class globally as well. Moving on then, how much, can Indian markets outperform? That's going to be important because on the way down, we did outperform. We fell less than what the globe did fall. Now, on the way up, can we do even better? That's going to be important because there are a lot of factors at play. The FI shorts, well, they have been getting added on. So if you look at the short positioning from around 30,000 contracts, in the last few trading sessions, it's moved up by close to around 4 times. And the FIs, actually, they've been successful because the Nifty as well has seen a correction of close to around, 1,000 points or thereabouts. So they've got the direction right. A short squeeze holds the key today, whether or not we can end virtually at the day's high. So the FIs covering their shorts is the most important factor for me for today's trading session. Moving on then, let's look at the options data. Call writing was very, very aggressive, as you can see. So we'll keep an eye out on some of these strikes. Do we start seeing some unwinding? That's what will tell you that the call writers are getting nervous and the bulls are fighting back. So keep an eye out on some call writing because in the last few trading sessions, the call writing has been very, very aggressive. Which brings us to the levels. The important levels on the Nifty should come up for you on the screen. The 22,900 to around 23,000 mark is very, very important. 20 and 50 DMA come in out there. So by the end of trade, you'll want to end closer to that mark. On the Nifty Bank, well, that was doing a relative outperformance. Then it cooled off a little bit. You've got your first hurdle at around the 200 DMA, and that's going to be very, very important. If we get past that, then the recent high comes into question. But that's the important mark you're looking at. Stocks that I'm looking at metals. Why is that? Because the dollar index has cooled off, which is normally positive for metal prices. The other factor is that the metal stocks have got smashed. And for both these two names, we have company-specific triggers. For Tata Steel, they're talking about cutting cost at Netherlands, so that's a positive. And for Vedanta, we have a special situation that's playing out. Both these two stocks will start off well in the green. Let's see how they do from there, because the problem if the globe is going to go into a recessionary trend, then that's what will weigh on there. But otherwise, both these two stocks should do quite well.
All right, Nigel, thanks very much for that. So metals on Nigel's radar as we start today's session. Let's just get you some views here. So Michael Gapon of Morgan Stanley says that the 90-day delay in reciprocal tariff reduces immediate downside risk, but prolongs uncertainty. And with the effective tariff rate at 23%, there is a narrow gap between a slow growth outlook and a downturn. The U.S. economy is still living on the edge. They maintain their outlook for no Fed rate cuts in 2025 and backloaded cuts in 2026 for a terminal rate of 2.5 to 2.75%. He adds a downturn could bring rate cuts forward.
All right, on equities, Mahesh Nadurkar of Jefferies says amidst global uncertainties, absolute index performance is difficult to predict, but India should emerge as a relative outperformer. Lesser dependence to US and China demand, relatively lower tariff incidence, lower oil prices, low FPI weights, and a pro-growth RBI stance are the key reasons. Their preferred sectors in India are lenders, power, telecom, autos, and real estate.
Jahangir Aziz is now with us, Head of Emerging Market Economics Research at JP Morgan. Jahangir, good morning. Good to have you back on the program. A lot has happened since the last time we spoke. I will ask you, of course, what your forecasts are for US, odds of a US recession, and etc. But first, a quick word on what the bond market is doing, because I think a lot of attention there. That bonds are not, US, it's not acting as risk-free. It's not acting as a safe haven, US government bonds. What's the problem, Jahangir?
Look, I mean, it's the manner in which these tariffs and the other policy changes that have been undertaken in the last, 3-4 weeks. I think we began the year and the view that, there would be extreme policy shifts under the Trump administration. That was given. However, regardless of how extreme these shifts would be, one thing that would be preserved is that the balance of these policies would be pro-growth, and the balance of these policies would be geared towards extending the expansion rather than truncating it. I think that's the question that the last 3-4 weeks of policy flip-flops, extreme tariffs, and alongside that, the other policies that are taking place in terms of, DOGE-related and immigration-related policy changes, I think that has crept in. And I think because that has crept in, you're seeing that being reflected both in a rise in the risk premium on US bonds, as well as the dollar actually doing the opposite of what it does in typical global risk-offs, which is that instead of appreciating, it is actually depreciating.
So is this is it a temporary thing, Jahangir? Or you think this safe haven status, dollar, US assets, dollar, etc. I mean, it's being questioned a little more permanently here.
No, I don't think that it's a permanent shift in US dollar being the safe haven. I mean, look, there are obviously undertones in the broad strategy of the administration that the safe haven or the reserve currency status of the dollar had artificially appreciated the dollar over the last 25, 30, 40 years. And that has been one of the reasons as to why U.S. has a trade deficit. Now, whether you agree with that argument or not, there are, high-up members of the White House, people like Stephen Merrin, et cetera, who wrote a note back in November arguing this, making this argument. So clearly there's an undertone within the different things that the administration doing is that they want the dollar to be lower. And one of the reasons as to why the dollar is higher is because of its reserve currency status. I don't think that, this is a permanent shift, but I think the acts that they're doing or the actions that they're taking is questioning that, at least temporarily. And again, you do have this time two other, alternatives, euro and the yen. If you didn't have them, then I think you would still go back into dollar strength.
Oh, absolutely. And we've seen that. I mean, the move on the yen has appreciated big time, 143 this morning. Yep. And the euro, I mean, look at the euro, just march higher, 1.1 plus on the euro dollar as well. Jahangir, great to have you with us on the show today. So it seems, at least for now, the bond vigilantes have prevailed. They've managed to rein in Mr. Trump. Now, from gauging risk perspective, is the worst behind us, you think? Because he's climbed down, he's opened this 90-day window. And when he was asked whether he'll extend the window, he didn't outrightly deny that reporter question. He said, we'll see. So it's only the China issue which remains outstanding. Would you believe that the inflationary impact and the worst impact of these tariffs, at least with the rest of the world, that risk has blown over?
So think about what the average effective tariff rate is. Right. So before the pause, after April 2nd, the average effective tariff rate rose to 23% for the US. Right. Then came the retaliatory tariffs on China, and then the pause. And after all of this, you now have an average effective tariff rate of 25%, and that I'm using based on the 125% tariff on China, not the 145. If you do that, it's probably close to about 27%. And this does not include the tariffs that are forthcoming, which is on auto, semiconductors, copper, and autos that are coming. Pharmaceuticals that are coming in the next couple of weeks. You add them two together, or add these three together, and you're now pushing it close to 30% of tariff with 145 on China. Regardless of which way you cut it, if you put in a tariff of this size, doesn't really matter whether the focus is on China or not on other people, you are going to get prices to go up. So I don't see how this alleviates any of the inflationary problems that China has, that US has.
So recession?
So after the pause, we are still sticking with that. Second half of the US will go into recession. That was a baseline prior to the pause. That remains a baseline. For global recession, we still don't have it in a baseline, but we have a 60% probability. We haven't changed that probability. I think people are missing out an important part of all of this dynamics. It is easy to say that, look, the focus is only on China. It is on China. But if you have 125 or 145% tariff on China, and China has 185% tariff on US, under those circumstances, US-China trade will virtually freeze. I mean, unless you critically need something, you are not going to participate in any transaction between US and China. And if that happens, and I know that, people mention that, well, the exposure to US and China is low, or US is low, or China is low, and therefore that country is safe. Most of the other trade that people do, let's say in India's case, most of the trade that India does outside of US and China is also related to the supply chain that goes through US and China. So if the trade between US and China comes to a halt, this is a actual shock to the global trading system. The two largest traders in the world are not trading with one another. And if you have a shock to the global trading system, no one gets spared.
All right, Jahangir, very quickly before we let you go, the dollar index has weakened, and normally we would say emerging markets do well. But now there's an additional factor. The US yields are holding up. In this sort of environment, how do you see flows move, for emerging markets like in India as well as China?
The lifeblood, so leave China aside. If you look at all of the emerging markets, the emerging market ex-China, and you draw a chart, their growth rate, emerging market ex-China's growth rate and global trade, there is no daylight between the two of them. You do that for India, there is no daylight between the two of them. So if global trade is under attack and global trade actually stumbles in the next 2, 3, 4 months before, let's say, we have a negotiated compromise, then I do not think that emerging markets growth gets spared. If emerging market growth doesn't get spared, as you well know, there is no flow to emerging markets. Now, the question is, will there be outflows? Well, I don't see there's much room for outflows because there weren't any flows over the last 3-4 years in the emerging markets for that to flow out. So I think that is a saving grace if you look at it that way.
All right.
Jahangir, just 30 seconds.
Sure.
You think they will try something new? Because, this experiment has failed. You think there will be another attempt some other way? I'm talking about...
Look, I mean, it is... Yes, I think having these kinds of tariffs on China and US on China on US and US and China is untenable, right? So clearly there has to be a solution, a resolution of this. We have no real sense of what the resolution is going to be and how long it will take. but you can't have a global trade system where the two largest players are putting triple-digit tariffs on each other. That's just not a tenable situation.
And if you think that they really wanted lower dollar and lower yields, they've not got lower yields. Temporarily, they got under 4%, but they've certainly got dollar lower. But of course, I mean, the collateral damage is confidence and everything else, right?
Yes. Yes.
So I mean, it's.
So I don't think it's.
Yeah, go on.
Yeah, look, I mean, these are thoughts that have been put out by the White House and people around the White House, in the White House. I don't think there's a very well thought out argument. I know most of my clients ask me about the consistency in the policy of this administration. I don't think you should look for consistency in these policies.
Okay.
I think what you should look for is the policy and try to figure out what the impact is going to be.
Don't try and form a coherent explanation, right, to what is going on, because maybe there isn't one, as you say. Jahangir, great conversation. Thank you very much, as always, and I look forward to our next one. And do join us more frequently. We need you with all that is happening. So thank you. Well, I think we're going to talk about individual stocks, top 10, with our research team coming up.
Welcome back. Okay, so we know that global markets are down a little bit. Let's see how we open up. The implied open is suggesting a 2% start because we have to catch up on Thursday as well. Let's talk about stocks now because several important names on our list this morning. Our team is standing by with the CNBC-TV18 list of top stocks to watch. And topping that list is what else but TCS. Rima, take it away.
Well, TCS has reported a subdued quarter. There was a modest miss on the company's top line versus expectations. Margins declined more than what the street was anticipating, so that's a bit disappointing. So on the top line, the company's constant currency revenue growth was down 0.8% sequentially. Dollar revenue down 1%. But if you look at the growth of the international markets, which is stripping BSNL, then this time the company managed to grow it by 0.6%. EBIT margins were a disappointment. EBIT margins declined 30 basis points sequentially. And if you look at it on a year-on-year basis, it's a fall of 180 basis points to 24.2%. The management in the press conference did allude to decision-making cycles had started slowing down in the month of February, so it did affect Q4. But going forward, it's not that clients are panicking. It's not that major ramp downs are taking place or major deal cancellations, but they are seeing instances of that. And the sectors which are most impacted on expected lines, it's consumer, retail, logistics, auto in particular, has been impacted. The company did maintain that FY26 growth in the major markets, your developed markets, ex of India, will be better than FY25. And due to the uncertain environment, at least as of now, the company is not rolling out its wage hikes, which they typically do 1st of April. They said they will decide on the wage hike cycle during the course of the year.
All right, thanks a lot for that, Rima. And stay tuned. The management interview comes up at 8:45 a.m. later today. They'll detail their numbers as well as the way ahead. I'm looking at another Tata Group company, that's Tata Steel. They laid out a plan to transform the way Tata Steel Netherlands is functioning, and they have laid out a major transformation program. Now, what the management says is that they're estimating close to around 500 million euros of savings by the second half of FY26. And in FY27, there will be another 50 million euros. So put it together, they're looking at a savings of around 550 million euros, large one. Investec, well, they say that this translates to cost savings of close to around $80 on a per ton basis for Tata Steel Netherlands. How do they achieve this? A third of their workforce, a third of this will come in from a reduction of workforce. They're talking about reducing the total number of employees by around 1,600 on a base of close to around 12,000. Besides that, they're looking at volumes, product mix, blast furnace efficiency as well. The other important factors that they clarified, they said that the direct impact of the US tariffs is limited because they barely export anything to US from any of their units. And also they mentioned that Tata Steel UK is expected to cash break even by the second quarter of FY26. So brokerages, they're positive on it. They're viewing this as a positive move. In the next couple of years, the results will show up. Let's hop across to Vinny. She's here with regard to Biocon and Sun Pharma. Vinny?
Good morning. So yes, both these pharma companies are going to be in focus. Positive news flows that have come in for Biocon as well as Sun Pharma. Firstly, Biocon, they've expanded their oncology portfolio in the US now after the US FDA has actually approved Biocon Biologics biosimilar, which is called bevacizumab. Now, this is mainly used for treatment of cancer. So this is an important drug. They already have two such oncology portfolios in the US. This is the third one. And they've been doing quite well in terms of market share over the last few years in their oncology portfolio. Currently, the market share and market size of this new biosimilar is around $2 billion, and this was in 2023. There are 4 other players who are already there in the US, but still they're expecting good growth in this one. What analysts are highlighting, they're estimating incremental sales of around $63 million in FY26 from this biosimilar, as well as $88 million in FY27. So interesting to watch out for in terms of Biocon, an important update there. Sun Pharma expecting green here as well. The US Court of Appeals for Federal Circuit has ruled in favor of one of the injunctions that was going on for Sun Pharma. So right now the ruling has come in favor of the company. So they can launch this drug that is called Lexelvi. This is an alopecia drug. It's a smaller market there, but surely a positive sign. The company was quite positive on this one. They'd spoken about how important this drug is for the company as well. Now, they've not yet decided a timeline when the launch will come in. So that uncertainty is there. But analysts are expecting maybe this could be launched in the next couple of weeks or a month is what we could watch out for, versus previously in Q4 FY27 when the patent would be lifted in December 26. So yes, important update coming in for Sun Pharma. UBS is saying that this is a big positive. Margin expansion story comes in for Sun Pharma, as well as the peak sales for Lexelvi could be in the range of around $400 to $500 million for this drug, and important for Sun Pharma.
$400 to $500 million. That's a sizable sum. All right, Vinny, thank you very much for that. Let's talk about gold financiers. These stocks were under pressure on, on Wednesday as well. Vamakshi is here. Vamakshi, finally, those RBI draft norms, they're out.
Well, absolutely should be. They're out. And, let me first take you through some of the important points of the draft rules. The LTV ratio is capped at 75%. The tenure is capped at 12 months for bullet payments. Further, they also say that NBFCs must set limits on gold loan portfolios. Now, let's take a look at what brokerages are saying on these draft norms. Well, Jefferies is saying that tighter LTV norms can have some impact on growth as well as provisions. Gold loan rollover norms, though tighter, are not as harsh as they had feared. However, higher OPEX could be considered due to end-use monitoring, but this again, they believe could be manageable. As far as gold NBFCs are concerned, they believe that they appear as a good defensive hedge in the current environment. They prefer Muthoot. They have a target price of 2,615 rupees per share on this one. Morgan Stanley remains equal weight on Muthoot. They believe that the stock could be under pressure in the near term. As far as Manappuram is concerned, they have an equal weight call on this as well. They believe that the company is better placed given Bain's open offer price. Lastly, let's also look at the note that came in from CLSA. They believe that the guidelines are marginally disruptive as far as growth is concerned. For both Muthoot and Manappuram, they're building in 12 to 15% loan growth from FY26 to 27. So overall, going with the red for gold financiers.
No, absolutely, and we'll see how these stocks move. 7% lower on Wednesday for Muthoot. Bharti Hexacom and Indus Towers in focus. Back to Rima.
Well, if you remember, in the month of February, Bharti Hexacom and Bharti Airtel had announced that they will be selling certain towers to Indus Towers. Now, in the case of Bharti Hexacom, the company has announced that due to intervention from TCIL, that's Telecommunications Consultants of India Limited, it's a Government of India entity which owns 15% stake in Hexaware. There is opposition, and therefore Bharti Hexacom is not going to go ahead with its plans to sell 3,400 towers to Indus Towers for 1,134 crore rupees. So that deal has been put on hold. So it's negative for Bharti Hexacom, but the market mood, everything's up. So let's see how the stocks play out.
Okay, all right. Rima, thank you for that. Sudarshan is here with details on Samvardhana Motherson and Ola. So good morning.
Morning, Prashant. So, Samvardhan Motherson has announced that it has begun cost optimization measures for European business, and company believes that once it's completed, that's over next 3 years, company is likely to save 50 million euros per year after the completion, and that's one of the reasons that I'm going with green for Motherson. Next is Ola Electric. As per sources, we understand that Road Ministry has received reply from Ola Electric with respect to discrepancies in February sales. If you remember that Ola Electric had said that in February, company had done sales of around 25,000 units, while Vahan website was showing that it has done less than 8,000 units. So related to that, now Road Ministry is saying, as per sources, that it has sought clarification from the company before sending the final note, and because of that, I'm going with red on Ola Electric.
Okay, all right, got it. So Ola Electric in the spotlight as well. Back to Vamakshi then. Anand Rathi came out with its Q4 numbers. Vamakshi, how do they look?
Well, so it will be not a great set, I would say. When you look at the AUM, that stood at 77,103 crores. This is a marginal uptick of only 1% sequentially. Keep in mind that they had guided for an AUM of almost 80,000 crores in FY25, so they've fallen short of that guidance. However, on the flip side, they've managed to meet the revenue and the net profit guidance. Let me quickly take you through the Q4 numbers then. The total revenue from operations saw a dip of almost 6%, coming in at 222 odd crores. Keep in mind that the trail revenue, that is the earnings that they earn from mutual funds on distribution of, mutual funds of equity and debt, that saw a dip of almost 5%. Distribution of other financial products also dipped by almost 7% for the company. As far as the cost to income ratio is concerned, that, however, came on the higher side. It was at 59.08%, an uptick of almost 425 basis points sequentially, and that is because the employee cost as well as the other expenses remain more or less stable, growing by only 1 to 2% sequentially. The net profit for the company has seen a dip of 5% sequentially, so not a great set for Anand Rathi, but the guidance for FY26 is also out. They say that revenue could stand at 1,175 crores. This implies a revenue growth of almost 25% as compared to FY25. Net profit at 375 crores and AUM at 1 lakh crore is what they're expecting going forward. So therefore, when you look at the numbers from Anand Rathi, not a great set, going with the red for this counter.
Okay, the volatility in the market perhaps weighing on the performance. Thanks for that, Vamakshi. Let's quickly recap our list of stocks to watch today. The ones that have positive news flow around them are Tata Steel, Biocon, Sun Pharma and Samvardhana Motherson. Stocks with negative news flow are more in number today: TCS, Gold Financiers, Bharti Hexacom, Indus Towers, Ola Electric and Anand Rathi. All right, with that, let's take a very quick break. We'll come back on the other side and get some fundamental ideas with Dipan Mehta and discuss the latest with him.
Welcome back to Bazaar Morning Call. Well, Dipan Mehta, Director at Elixir Equity, joins us on the show. Hi, Dipan. Good morning. It's going to be a green start, but as we said earlier, it's not the start, but where do we end? That's going to be important because the global markets are still in a bit of a tizzy. Let's talk about the top stock, though, for the day. TCS reported its numbers. You know, the global cues, though, are not very, very positive with regard to deal flows, deal cancellations, rather. How do you read the stock and what would you do post the recent correction?
Yeah, good morning, Nigel, and thank you for having me on your show. I think that even after the recent correction and if there's by chance any bounce because overall markets are higher, one must still look at exiting out of TCS and other large and mid-cap software companies. It's very clear that the world is going to slow down. US is also going to slow down. Whether there's a recession, depression, difficult to say. But in this uncertain environment, TCS and other large companies are going to find it very challenging to show decent growth. Also, there's a lot of competition coming from GCCs, and that also going to impact the prospects of the Indian software industry. So I'd be very, very cautious in IT companies. I know they are attractive, they are cheap, they give out a lot of dividend buybacks. But end of the day, from an investor's perspective, you want growth if you want to create outperformance or serious wealth, and that's just not there in the software industry.
All right, Dipan, stay with us actually, and I request you to listen into the TCS interaction. So Rima and I caught up with the top TCS management. And we will play that out in just a bit after a quick break.
Welcome back. So Asian markets are seeing a slight recovery. Most of them are still down, but because US futures have recovered. When we started the program, US futures were down between 1% to 1.5%. Now they're down about 0.5%, the Dow and the S&P and even the Nasdaq. And that's why Asian markets have pulled back a little bit from a decline of 5.5%, for instance, in Japan. Now the decline is about 5%, 4.5% actually. So that's the picture across Asia for the time being. The implied open suggesting a 450 point sort of an up move as we kick things off. But for the time being, let's put the spotlight on TCS. Rima and Prashant caught up with the TCS top management to talk about the quarter gone by and more importantly about the outlook ahead. And they started off by asking about how the tariff war is impacting business.
We've also been watching the news like you've been. Our customers are also doing that. But what we are saying is many of our customers are also in a wait and watch mode in terms of what is the end game going to be. But good thing is, like whatever we have seen so far, as much as the rhetoric, we have not seen our customers panic. Like there are maybe some programs what we thought that they would kick off, but some delays in decision making. But we are not seeing any major cancellations or no major project ramp downs. Like there are few, but no major. So I don't think there is any major negative reaction so far.
You're saying this after the pause, or even when the tariffs were imposed and it looked like it could go on, you're saying no one really panicked, or it was wait and watch?
I have not seen leaks. I have not seen any major panic. Like there have been some, like some industries where it's been difficult. Like for instance, consumer business has been going through a tough time. Our airlines have been, but if you look at financial services have been doing okay. We have not seen any major disruption, like few delays here and there, but nothing major.
Have you spoken to clients in any segment after the pause?
After yesterday?
After the...
I had to prepare for a board.
I don't think anyone was sleeping, so I mean...
I think you need 100 kritis to speak to the 100 clients that...
But have you got any feedback in that sense? I mean, from your team in the US?
No, I have not had a chance to speak to our team since yesterday, but I also don't believe that there is any instant reaction is going to be of...
The reason I say that, I'm just going to press this a little bit more and then we'll get to numbers, that, you know, after what was announced, and even, I mean, this is the latest, economists, large bank economists are still predicting a recession, the probability of which was 80% 24 hours back, but now say it's 50%, 55%. A recession, real economic recession. So that's the context I ask you that question. What is your assessment, your own assessment now, on how this is going to play out for your business?
Prashant, that's what. I'm not an economist to predict anything.
No, but if those forecasts come true...
I will look at what my customers' immediate reactions or reactions the last 1 month has been. See, when I came and met you in the early part of January, I was sounding more optimistic. We were very sure that some early signs of recovery we have started witnessing. But as the quarter wore down, like we did see the uncertainties in the market, all the trade discussions, uncertainties. So made our customers sometimes delay the decision, pause some of the what we were expecting to start, or some of the programs that are awarded not start. So they wanted to, wherever they can wait and assess the situation before they have certainty. So there are such instances. But have I seen any major budget cuts? I have not seen any major budget cuts. I have not seen any major project cancellations. There are some tactical ramp downs here and there, but I won't panic at this time.
Was Q4, have you managed to steer clear in Q4 of this macro uncertainty, sporadic instances of ramp downs or project cancellations, or did Q4 also see an impact?
So the positive side of Q4, okay, all the major markets grew. Probably I think this is the first time in this year where all our major markets had a positive growth. And even from the business verticals, if you look at, of course, BFSI has been growing. BFSI, like every time I've been reporting BFSI North America, but this time BFSI in Europe, UK also grew. And we had growth coming in energy resources and even comms. So we had, of course, comms and all grew marginally, but of course, all of them had a positive growth. So overall, if you look at from a major market perspective, it's been a good number. But was there an impact? Yes, there was an impact. There was an impact.
What was the extent of the impact?
See, I'm not going to quantify how much was the impact, but there's a marginal impact.
Okay. And what happens to the early signs of discretionary spending that you spoke about 3 months back? Where are we at?
See, if I look at this quarter's, the other indication could be our order book. Okay, our order book has come in still strong, in fact, better than last quarter. Our order book is at 12.2. And of that, almost close to 7 billion has come from North America, 4 billion in BFSI, and close to about 1.7 or 1.6 coming from consumer business. And if I look at the discretionary spend portion of that, it remains same as the last quarter. And the good thing is, all this 12.2 billion has come in without the support of any mega deals also. If I take mega deals, this is actually the highest TCV in our recent history. So, so where I'm coming to, discretionary projects have not died down. There are probably some pause, and clients are thinking, should I start now or should I wait for a couple of more months till some certainty emerge? But otherwise, there is no major disruption to the overall situation.
What's the percentage of discretionary? What would you call discretionary as a total?
I would say about 30-40%. Like, I don't know.
We are not calling it out in the overall portfolio.
But roughly in the 30 to 40% or band, possible, right?
Possible. I say the ballpark could be.
Okay. Fair enough. Now let's just talk about Samir, the BSNL, and we always do this. So there was some expectation that margins would perhaps be higher. Because, and you've guided this as well, BSNL, you've said the margins are in single digit. As it ramps down, margins should get a lift. But that has not happened. Margins actually have come off a little bit. Can you explain what happened?
Sure. So our margins at 24.2% in the quarter, sequentially declined 30 basis points. BSNL overall, or through the ramping down, did give a 40 basis points benefit. We actually had 50 basis points benefit also coming in from operating leverage and support from currency giving us 40 basis points. The investments through the quarter, so we did tactical interventions, mainly merit-based interventions that impacting us by 100 basis points, and another 60 basis points on elevated non-employee expenses, the likes of travel, events during the quarter, and higher CSR expenses.
So this is the other expenses, which...
It would come into travel as well as other expenses is what you'll see on the...
Because the other expense component, the run rate used to be about 7,500 crores, has gone up to about 8,000 crores.
Correct. So that's reflected.
So that's
the marketing expenses also reflect.
And what would that number be in the future? What should we expect as a run rate? Yeah.
You can expect it around that... see, it's not a significant increase. If you take it's a 100, 200 crore, 300 crore increase sequentially. So it is still in that ballpark range.
Got that. And what about constant currency growth? I mean, is it possible to quantify that XF sort of BSNL?
So overall, we, as Kriti mentioned, all our major markets have grown positively, and I think the only degrowth you will see will be coming in from the India perspective.
So the constant currency is down 0.8%.
Yes.
And the estimate that I have is X of BSNL, actually there's a growth.
So if you were to calculate the major markets growth, it would ballpark be in the positive 0.6%. 0.6.
Milind, Q1 wage hikes on track. And given the uncertainty, will the increment amount be similar to last year or lower?
Given the uncertainty, you said, we will decide when to do the increments.
So typically, you roll it out 1st April.
Yeah, but this year we will decide when to do it increments based on the environment.
So you're deferring wage hikes as of now?
I'm saying, I will not use the word defer, but yeah, yes, it will decide it when it happens.
Okay. And what about your plan? You typically hire 40,000 freshers.
Yeah, so we did 42,000 FY25.
Last year.
FY26 we'll do either equal or a little more.
Okay. For the last so many years that I've been looking at TCS, your talent management was best in class. Your attrition was always lower than peers by a couple of basis points, sometimes 500, 600. But this time, the gap between you and your peers has narrowed. This time, as in the recent past. What explains that disconnect?
I think it is the way LTM is calculated. Different companies peak at different times, right? If you look at our quarterly annualized attrition, we actually has come down significantly this quarter. So I'm not much worried about that.
Not much. Krithi, while you're not majorly concerned and you're not seeing major disruptions, major cancellations or ramp downs, there are some instances of it. Sure. Give us some more nuance on that. Which are the verticals which will be most impacted?
As I said, consumer business, auto. These two I hear most often. Like as I said, comms I want to, while we had a growth, but I need to see whether it sustains. Tech business has grown, I think last quarter also it grew, right?
Yes.
But going forward in terms of headwinds?
That's what I'm saying. Like tech has a professional services could be within tech, like we also include professional services. There could be a softness in professional services. So I would say from order wise, like consumer business, which includes retail, CPG, travel, airlines, and auto, and professional services. I would say these could be softer. Core banking, I'm finding so far resilient, and there are good opportunities in pharma and healthcare.
And last time you also said that FY26, so calendar year 25, looks better than calendar year 24, especially for the international markets. Do you hold on to that?
So if you look at our FY25 growth, it's been better than FY24 growth. However small the difference is.
What about this year?
That's what I'm coming to. So I believe FY26 will be better than FY25.
Stripping out BSNL.
I would want to do it with or without BSNL. I want it to be better, but definitely still.
I asked this last time also. So 3% is the BSNL is about 3% of revenues.
Yeah. Overall, CC growth for this quarter is 4.2%.
Yeah, but so that is going to wind down by the end of the year, FY26.
Yeah, it should be. The current contract should be winding down in Q1.
So there is that, and then there is all this trade uncertainty, etc. But obviously, I mean, you're kind of factoring all that in when you say.
If you say it will be better, definitely our international market will be better.
Right.
Okay. Whether if I after XBSNL, definitely we hope that it will be better. I should not say definitely. We are confident it will be better. Okay. Including BSNL, there's every likelihood that there's an aspiration to make it better.
But it's very rare when TCS decides not to roll out wage hikes on the due date.
That's primarily because he's been talking about is yesterday better than today. Okay, there is so much of uncertainty. Like we just want to ensure that we are in the right place to offer the.
But if all this kind of settles down, it's possible, right? There's this 90-day pause which has happened, and who knows? I mean, maybe the outcome finally is much better than what we know now. You will roll this out. I mean, this is
absolutely.
So this is primarily on account of this uncertainty.
Yes, absolutely.
Right. In the US, in terms of hiring in the US, your employees, I mean, all that. Is there anything which has changed from the last time we spoke?
No, we have continued to hire there. We actually had a good hiring this quarter itself, and that model is very robust for us. So we continue to hire both from the market and from the campus.
Because you keep hearing all these, some legislation has been moved to do this, to do that. I mean, just a lot of noise. I'm not sure how much of that actually is happening on the ground.
Yeah, that matter is under litigation, so I will not be able to comment on that. But as it comes, I'll update you.
Krithi, the feedback seems to be that ex of BSNL last year, your growth in developed markets was weaker than peers. What would you attribute the reason to? Is it less aggression on sales? Are you focusing too much on margins? Is Gen AI deflationary? What explains the underperformance versus peers for the international markets?
See, two things. Okay, not two things. First, like you say, you take BSNL out of our revenue. You take the inorganic growth out of the revenue of our competition, then you compare. Like most places, I would guess, it's whatever the difference you see, like BSNL, it's more or less equivalent to the inorganic growth others had. So if you take BSNL out for us, you take the inorganic growth for others.
So you don't think you've underperformed?
I don't think we have underperformed. It's either the inorganic growth or the BSNL.
Okay, well, that's the TCS top management. The headline seems to be that there are some tactical ramp downs, basically people deciding whether to start projects now, 1 month later, 2 months later. But those projects are there. There is no cancellation. There are no ramp downs. None of that is happening at this point, according to TCS. There has been a lot of short covering in this space, the IT space. Stocks have been smashed. The question is, will we see some covering today? And I think the answer perhaps is yes. In a minute or so, we'll start with the pre-open session and we'll have the rates come up quickly when they finally start to settle down a little bit. All right, Manisha is here with the roundup as far as commodities are concerned. Manisha, gold, I think I want to start, why don't you start there? I mean, high to low, gold prices fell 7% during this, over the last 3-4 days. Prices are back up?
Oh, absolutely. If you look at the last 2 trading sessions and, do not miss it out, but you've seen gold prices at an all-time highs yet again, trading above $32.100 an ounce. We've seen $100 of a jump up in last 2 trading sessions each day, and gold is on a track for best week since November 2004. Well, the US dollar index at a 3-year low clearly has been a supportive factor. The safe haven buying amid escalating US-China trade tensions is another thing. So this is an all-time high on gold on your screens, whether it's US dollar, it's Indian rupee, and various other major currencies as well. Some bit of a rebound is what the copper prices also seem to be holding. It was a 4% of gain yesterday. The markets are cheering US pause on reciprocal tariffs for 90 days. And the street does expect that the China will come out with aggressive stimulus measures. That seems to be supporting copper prices, which is off its 3-month lows that we saw it trading yesterday. The only thing that is headed for a very sharp decline is the crude oil prices. 4% down for this week. Prices are trading at around 4-year lows. The markets will, of course, watch out for the US data, and you have plenty of that coming in the day-to-day. That would give you further direction.
Okay, all right, Manisha, got it. Thank you very much for the updates over there. So getting set for the commodity open as well. Let's welcome in our technical experts, quickly get a sense of how to look at Friday's trade. Mitesh Thakkar with us along with Shrikant Chauhan. Gentlemen, morning. Good to have you on. Hope you got some good rest on the midweek holiday, the Thursday holiday. Mitesh, now what? I mean, today we might be up because the fact that we missed, Thursday's action, but generally the mood is a little soft and somber again.
That's right. I think, it's been difficult in the sense that it's been very news driven. So I think, you're getting gap ups, gap downs, and I was hoping that some volatility will settle down with the indicators kind of turning sideways. Again, with this pause news, we had a big move in the GIFT Nifty yesterday. Still, today is showing about 400 points positive. I would still now look at 22,800 as the key level. I think a close above that would add to strength. Otherwise, we might see that as the near-term support supply pivot. And therefore, I think, we will open around that level. So I think post-opening, if we don't see a follow-through, I would be keen to exit any long positions on the stock side, which I have, and wait for the market to come at lower levels. In case we fail to do that or get past 22,800, then I think we are in a broad range of about 22,200 to about 22,800.
By the way, right now, these Nifty rates are a little all over the place. Nifty suggesting a 70-point downtick. The sensex pre-open rates are actually on the positive side. But like I'm saying, some of the pharma stocks, 9%, Tata Steel you're getting at 4.5%, Tata Motors 9-10%. So let's wait for it to settle. Though the question is, there was one market holiday where we were not trading. The rest of the world fell big time. We thought in the morning, oh good, chalo, bach gaya. We escaped. But by the evening, it was down. Yeah. Now we want to believe we missed the rally on the way up, so we should have our share of it, right?
I just want to say one thing. I think what's happening is that US futures, they're down sharply now. So we were looking at that.
0.5%. When I saw them, they were down 0.5%. Let's see if have they declined even more.
I think the S&P 500 futures are down very sharply. I think about we'll have to maybe put the rates up and we will do that. But I think 3.5%, 4% lower on the S&P 500 futures.
Okay, I'm getting about 1.3% down, which again is a very sharp nosedive. It's been yo-yoing very sharply in a band of 0.5% to 1.5%.
Yeah.
Actually, a little all over the place.
What we'll do is we'll ask our team to put the futures rates as well, because I think there is, what's happening.
Now they're showing positive on my screen. I don't know what's going on.
I think that's the. that's the head, and the rest of the market, of course, is the tail. So that's the lead, and we are kind of sort of in a way following. So I think the cues will come from there. So maybe
just
we should
one
put
thing,
that
you know,
up as well.
Hormuz is telling me that actually the Dow futures, we'll have to recheck it. It's turned positive actually.
It has,
It's recovered all of those.
So let's actually put, let's just put those rates up at the bottom of the screen.
I don't think we have it right now, but I think it's turned positive. Yeah, it's recovered 600 points off the lows.
Yeah. So then, I mean, and let's just put the Nifty up as well now. 4 minutes into the pre-open. And
Nifty is also positive now, about a 0.25% higher. So in step with if the US starts recovering, then Asia starts recovering, then maybe we eventually do get that green on the screen.
I think it's nice. I mean, you know, on big days like this, if you remember when the pre-open was introduced, it was exactly for days like this, when the book is built, and and by the time it settles by 9:08, you get a real sense of, and it kind of avoids this, just open and then market is up 200 down, 200, 300 or whatever. So, but yeah, I mean, it's starting to reflect this a little bit more now. So 140 points higher it should be. Let's just get views now and trades as well. Gentlemen, good morning. Mitesh, why don't you tell us what to do in terms of specifics?
Yeah. On the stock side, Prashant, I have 3 buys to a sell. ICICI Prudential is a buy with a stop at 560 for targets of 595. Factor the gap in and see if the risk reward is still better than what is to do, because I think the closing was around 568. Same strategy on IDFC First Bank. Keep a stop below 58. Look for targets of 63.5. ACC is a buy with a stop at 1963 for targets of 2050. And one sell call, that's IGN on a bounce back. Sell around 177, 178. Keep a stop at 181. Look for targets of 170.
Srikanth, what about you? What's the index view and what are your trades?
Good morning, Prashant. Good morning, everyone. I think, what you said is absolutely right, that US is ahead and we are all like tails, and we are following to the overall news flow, which is getting span out. But if we consider the overall performance of our markets and response to the overall developments, I'm of the view that our markets have seen its worst on 7th of this month. I mean, say on Monday when the market was down and it was around 21,700. So the chances of moving higher are very bright. But the thing is that it is going to consolidate. It is going to remain volatile within the broader range. And the strategy should be to buy if there is any correction in the market. But at current levels, let's say in case if we see the market is opening somewhere close to 23,000 levels, then there we should look for taking some profit on long positions, or we should look for reducing long positions. That should be the strategy. But at current levels, based on the developments, we should focus more on metals. In that, we like Vedanta, we like Hindalco, we are expecting some short covering in Tata Steel. We like pharmaceutical stocks in that Sun Pharma, Syngene, PPL Pharma. These are the stocks to buy for. But specifically, Sun Pharma looks good at current levels with a target close to 1750. It is, I think, opening around 1700 levels. So maybe 1750 or 1800 is the next level to watch out for. And from the metal basket, we like Vedanta, which is around 370, 380 levels. There, I'm expecting stock to move towards 410 or 20, and we can keep a stop loss around 365.
Okay. All right. Got that, gentlemen. Thanks very much. We'll come back to you closer to market open. Just checking some of the stocks that were in news. Biocon seems to be reacting well to some of the drug announcements that they made. Muthoot Finance is still down. Muthoot and Manappuram, they were wobbly on Wednesday as well, but Muthoot is still carrying a cut of about 2%. I think we've got Deepan with us. Deepan, very quickly on these gold financiers, what to do now if you've seen the draft norms?
Yeah, Surbhi, I think that, yes, definitely, I think it will impose some additional restrictions. But end of the day, it is very good for the industry as a whole. And with gold prices where they are, I think that there's enough prospects for these companies to expand their gold lending business. And I think end of the day, it provides more security and safety to these gold companies, which is always good for shareholders. It's a great product per se. So I think at corrections, I wouldn't get too nervous. And maybe if they correct even further from these levels, if you have a 3 to 5 year type of a view, these companies could turn out to be outperformers.
Okay, all right, Deepan, if you don't like something at 100 rupees, it's okay. But will you like it at 80 rupees? I'm asking you about metal stocks. Today, they're likely to open up in the green. You didn't like them higher, but they've seen a big correction. Tata Steel is talking about turning things around at Netherlands. Vedanta, we know there's a special situation, that's playing out. Excites you now or not at all?
See, I think, Nigel, money is always scarce. And in markets like this, when they are correcting and tomorrow, who knows, there could be a capitulation. You want to go for solid businesses, India-centric businesses, companies which are not impacted by global growth, slowdown in global growth. So from that point of view, I think I prefer many other sectors over metals. But yes, I think in Vedanta, there certainly is an arbitrage type of an opportunity. And look, if you're an expert in metals and you understand the industry well and the tops and the bottoms, then certainly you could trade in them because they are volatile and they offer a lot of trading opportunities. But I prefer to go for stocks where I can hold for 3 to 5 years or so, and I don't see those kind of prospects in metal companies.
Okay. All right, Dipan, got it. Thank you very much for joining in. Shorter chat today, but I really appreciate you being with us. Let's quickly put the spotlight on the pharma space. Now, that's where a sword is hanging. President Trump has said tariffs are coming. We just don't know what, how much, and when. We have Bino Pathamparampil, Head of Research at Elara, joining in for some quick thoughts. Bino, thanks for joining in. So, obviously, we have no numbers to really work with, but in terms of just exposure to the US as a percentage of total revenue, which are the companies that are at maximum risk as of now?
Hi, good morning. So most of the large Indian pharma companies have a pretty high exposure to the US generics market. Maybe after the Indian market, they are all exposed to the US market. If you name a few of them, Dr. Reddy's Labs, Zydus Lifesciences, Aurobindo, even Cipla and Sun Pharma, all of them have 30 to 40% of their revenues coming from the US market. So to that extent, all of them would be vulnerable if at all any significant tariff is imposed on Indian pharma by the Trump administration.
Okay. So most of the generic players would be impacted, but some also have facilities. I mean, Sun, for instance, Sun Pharma, they have manufacturing facilities either in the US, some could be in the zone of Canada, Mexico as well, where there is still a trade agreement in place. Do you expect any immediate supply chain changes if, let's say, Trump goes ahead with a 25% levy on pharma imports?
Supply chain changes in the pharmaceutical industry are pretty laborious and takes time. The US FDA approval for pharmaceutical products come tied to the facility from which they are manufactured. So if tariffs come through, it's not that from next week onwards you can more manufacture the product in the US or Canada or Mexico and stop or reduce manufacturing in India. The switch of manufacturing is a laborious process. So for the time being, the additional cost of tariff will have to be borne by somebody. We believe that most of it, maybe 80-90% of it, that will get passed on to the end customer, but still there could be a small part of it which may hit the margins of the generic company manufacturers.
Okay, all right. Bino, aside from Trump's tariffs, I want your view on Cipla. Vinny has sent us an alert that they've received the US FDA approval for Abraxane, and I believe it's come sooner than expected, and I believe that this is used to treat cancer, namely breast cancer. Any view on it? How much of a positive is it?
This is an approval which has been expected for long. It was getting delayed because of the issues that Cipla had with their manufacturing quality at their Goa plant. The plant has now been cleared, and following that, the US FDA has approved the drug. The contribution from this drug is possibly already built into the current earnings estimates for Cipla. So this per se does not increase the earnings estimates for the coming couple of years. But at the same time, there was risk of further delays, which has been alleviated with this approval coming through. So it's a positive development.
All right, Bino, we'll sort of continue to track this closely, but appreciate you joining us this morning with those sort of specifics and that view and that commentary which is coming in at this point. I think we've got 2 minutes to go for the pre-open, for the market open to kick off, and I think it's higher.
300 points up?
300 points. I mean, it's a respectable 1%. Yes. I mean, The opening was a little, skittish in here and there, but that's the purpose of the pre-open. I mean, the book gets built and then you get a real sense of how things will start by about 9:08, 9:09. And it is slightly higher.
Even TCS, I was just checking,
yeah.
TCS, despite its subdued commentary, even the fourth quarter has been a bit of a washout, but it's all about forward-looking.
Yeah.
The stock's up about 1.5% because it's already fallen so much, so how much more?
And the commentary was not bad. It's very uncertain, etc. But it's not. It was not downbeat. 26 will be better than 25. Definitely ex-BSNL, maybe with BSNL as well. And there are no cancellations, etc. yet. That's coming through. There's no, I mean, it's not a big growth story. The point with IT, there are good stories in IT as well. Coforge, for example, stocks fallen 40% from highs. But for the larger guys, I mean, heavily shorted sector, stocks have fallen. So maybe at a trading level, there is a little bit of a bounce here. So we'll see. 1.5 higher on the Nifty is what you have. The Nifty Bank is up about 1%. 1.25 now, so picking up pace. Small cap index is up 2.4%, and I think you'll have the mid cap index, which will come up 1.7% higher on the mid cap index as well. So 22,750 is where the Nifty is starting, and 50,850 is where the Nifty Bank is starting. The heat map is up on your screen, and it'll give you a sense of how we are looking. It's all green. HDFC Life is a loser. Otherwise, it's all up and about.
Absolutely. Like Nigel said, I think that's the statement of the day. We all know we'll start in the green. Where we end is the bigger question. For that, we have to wait till 3:30. Anyway, for now, Pharma is actually leading it on the way up. Sun Pharma, Reddy, Cipla, all of these pharma stocks are seeing a relief move, 3 to 4%. Maybe hoping that the pharma tariffs also get delayed. What else is higher? Tata Steel, JSW Steel up and about. There's some buying on ONGC, Hindalco. In general, the commodities universe is doing well. There's Wipro, 2.5% up. Infosys, tech is rebounding. Tech Mahindra is up. Let's see TCS. Amidst this tech rebound, TCS is actually down. TCS is down about 0.25%. So the positivity isn't quite rubbing off because the commentary is subdued. There's nothing very much to take home from it. In fact, TCS is the only negative stock on the Nifty as we speak. Where are the financials? The Bank Nifty is up about 1.2%. So it's looking pretty okay. ICICI Bank is up 1.1% at this point in time. HDFC Bank is up about 2%. Kotak also higher. Most of your private sector names are up and about. Axis is very flat. SBI is also doing pretty well. So banks up, IT is recovering, but not TCS. And the global-facing sectors like pharma and metals, they are definitely having a good start.
Well, that's right. Tata Steel is in the green. They've laid out a plan to reduce costs at Tata Steel Netherlands. And that's what could result in big, upgrades if it actually fructifies. For the time being, Investec was one stock that had upgraded the stock to hold. Earlier, they had a negative rating on the stock, so that stock is well in the green. Vedanta, that's bouncing back as well, up close to around 3.5%. You have Nalco, another metal stock that's seen a sharp correction from around, I think, 200 plus levels. It corrected to around 140, seeing a bit of a relief rally. Tata Motors is up 3.5%. Samadana Motherson as well is higher in today's trading session. Goldium, just pull up that stock. That's up close to around 15%. The reason is that US tariffs have been deferred. That's a positive development. The stock, I think, had half from the top. Remember, they get meaningful revenues coming in from the United States. So that's why this tariff deferral is actually very, very beneficial. That explains why that stock is now flying away, up close to around 15% as we speak. So a good start to trade. Metals doing well, IT is doing well, and some of these stocks like Goldium seeing a good relief rally. A good start, Prashant.
No, it is definitely a good start. What is happening with Muthoot? I'm just seeing. Muthoot is, on my screen, is showing a 5% cut right now. It is down 5%. And it's got massive volumes as well. At this point in time. Remember, on Wednesday, the stock was down 10. It ended 7% lower and is down another 5.5% as we speak. We'll try and have the management of Muthoot join us as we go along, but that is the stock on the downside that I think is playing out at this stage. Otherwise, I can't spot very much with volumes on the downside with any meaningful price move as well. I think on the upside, we've kind of highlighted bulk of what's happening. Maybe just one or two more names. Avanti Feed, the shrimp player, 6% higher. And surprisingly, we don't see it on the volume leaderboard, but it's the third largest volume name on the NSE right now. Look at that, about 400,000 shares. PI Industries, specialty chemicals, 6.5% higher on PI Industries. So 3,500 coming through there. LT Foods is up 5.5%. I think these are individual, tariff relief kind of plays which are coming through. Camlin Fine, another name there in the chemicals pharma space, 12% higher on Camlin Fine, 150. So yeah, this sector, chemicals as a space, also was perceived to be impacted a little bit more than others. But here you've got some gains which are coming through.
Just one note on Manappuram, on Muthoot, sorry. I'm reading an Ambit note. They have gone ahead. They were very positive on the stock. They have turned sellers. They've cut the target price by around 24%. And they've cut the EPS estimates as well for the next few years. Because of the lower LTVs, they're saying that the lower, now there's a level playing field on LTV norms. That's what will reset the long-term growth expectations. And that's why they believe it warrants a D-rating. So they've gone ahead, cut big target price cut, and they've turned sellers.
So I still remember this conversation that we had with Mr. Muthoot. At that point, they had maintained that while NBFCs are not capped at 70, at that point, NBFCs weren't capped at 75%. Industry practice was keeping LTVs as high as 90%. But I remember him saying that they, in general, try and limit it to a level of banks, which is 75%. But clearly, that's not the case. The other important takeaway from these draft RBI norms is the fact that the gold itself that you're leveraging, RBI said that you have to treat all gold as 22 carat purity gold. A lot of times the ornaments that are coming in are lower than 22 carat. So it doesn't matter. You can't, overlend if the gold is not of that purity. You have to take the value as if it was 22, reduce the value and then lend. So perhaps some of this is going to...
We'll try and invite Muthoot and we'll try and invite the Ambit analyst as well on this, because this is the stock of the day on the downside, which is coming through. Devina Mehra is with us, founder, chairperson and managing director at First Global. Devina, good morning. Great to have you with us here on the program. Thanks very much. Where do we go from here? What next for markets here in India, Devina, for our Indian audiences?
Good morning. My advice actually has not changed very much. This Monday, which was supposed to be a manic Monday, I had breakfast at a 100-year-old cafe just to remind myself that there are many things that happen which in the moment appear very tumultuous, but eventually, the golden mantra is that this too shall pass. And to some extent, India, in any case, even when the tariffs were imposed before the rollback, was relatively a little insulated, one, because we don't have that much external exposure, and two, on a relative basis, it was a possibility that you could actually be gainers because the tariffs were vis-a-vis the US and all your competitors had higher tariffs. But for the moment, that's on the pause button has been set on that. So my advice remains pretty much the same as it has been for the last 10 days, which is that if you, whatever is your equity allocation, which should never be 100%, you should remain invested. But in a steadier portfolio, if you had invested in the themes of 2024 or were overexposed to small and micro caps, you have to recalibrate. So don't try to make it up from the same stocks or the same strategy or the same scheme. That's what I always say, that just because you bought something at 100 and now it's 60, don't try to go back to 100 with that, because the market has no interest in what your purchase price was. So broadly, I would still say remain invested, because the risk of a crash for the large cap steady state is not very high, which is not to say there's absolutely cannot be any downside in the indexes from here, but the risk reward is in your favor, in the sense that the percentage the market can fall is probably less than the percentage it can rise. And when there is anxiety, when these questions come that should I pull out of the market, should I stop my SIPs, is usually in hindsight the very time that you should remain invested.
Devina, just one more question, and then my colleagues will come in. Since diversification is a big theme, and obviously at a larger level it does not change, but this is a more near-term kind of question. U.S. assets generally have seen, it's like the U.S. passport, right? Extraordinary privilege. Same with U.S. assets. Do you think that has taken a bit of a knock after what we've seen? Or again, as you began by saying, that 100-year-old cafe, this too shall pass and nothing. But then, in that sense, nothing ever matters.
No, I mean, the US, I think, has taken a knock. I mean, see, first of all, let's first look at the US market. So first of all, this is also a mantra I keep repeating, that the global does not mean the US. US may be the largest market, but global diversification doesn't mean that you buy an S&P or a NASDAQ ETF and no, that's not good enough. And while in the near term, we also think that if the US doesn't do well, nothing will do well. But if you look at, let's say, the period between 2003 to 2007, and that was the time US was not coming off a high. It was already in the doldrums after the tech crash. And yet in that 4 or 5 year period, it did practically nothing. I mean, for the entire period, it was up only 65%. Remember, the NASDAQ high of 2000 was not taken out till 2015. And in that 2003 to 7 period, the emerging market index went up 3.5, 4 times. India went up 6 times. Brazil went up 10 times. So there can be a disconnect. So, so that's the market part. But and US has been outperforming for about 12 years. So anyway, I'd been watching that sometime that outperformance would end. If you'd asked me 6 months ago, I would have said that we are watching, but nothing looks imminent. But I think Trump has hastened the end of the US outperformance. And more than that, whatever US has done has hurt, I think, even on a long-term basis, the US dollar's position as the reserve currency of the world and the trade currency of the world. People will start to look at alternatives. 2 years ago, I had made a video saying de-dollarization will not happen in a hurry because reserve currencies don't change in a hurry. But I think Trump has shaken something fundamental about the trust in US, because US was not just a rich country. It was a country where the world looked up to for its rule of law, its institutions, all of those things, intellectual freedom. It literally attracted the best and brightest from around the world. And that part, it is changing. Like, for example, a lot of East Asian countries did become much richer, but they did not attract the talent from the world because of all these things, that they did not have this reputation of great institutions and freedoms, which US did. So, yeah, there's some permanent damage to America for sure, but that doesn't mean that you should not, as an Indian resident, diversify, because, again, putting all your eggs in one basket is never a sensible strategy. And this is not something for a 6-month view. It is something you have to do over a period of time.
Hi, Devina. Good morning. Good to see you, Ben. On Monday morning, people are talking about a Black Monday. I saw your tweet at that point of time, and I'd rather be with you at Cafe New York, having that delicious breakfast. That said, you've already answered a couple of my questions with regard to India or in emerging markets could outperform, and that's a possibility. The US markets don't perform that well. And over the last few years, you've seen the US market capitalization as a percentage of the total global market capitalization has actually gone up. So maybe it's time for them to unwind some part of that outperformance. That said, the SIPs, we're keeping it going, and I think most investors as well, they have faith. But what would your asset allocation strategy be as of now? Because maybe in the next 12 months or so, your fixed income could give better returns than equity. Just maybe, that 8 to 10% return or thereabouts. So what do your asset allocation advice be to a lot of our investors?
I normally say that don't change your asset allocation too frequently, because it's very difficult to time that. So it is usually a good idea to decide broadly on your asset allocation. Don't tinker around too much with it, because what you end up doing mostly is chasing the last asset or last strategy that did well. So that's what you will end up doing. And that, if you do it systematically, you systematically bring down returns. So we have, like for equities, all these calculations that this is how equities compounded for 20 years, 30 years, I'm talking even for India. But if you look at the mutual fund data, you will find that most people do not remain, majority of the people, more than 50% of the people do not remain invested for more than 2 years. So that's the data. So that's what causes the actual underperformance. As I said, the time you are asking, the time to ask this question actually usually is when you are absolutely gung-ho and you think that the equity markets are going to do brilliantly, which was the case for most of 2024, let alone small investors. I had family offices coming to me, saying that, why are you so risk averse? We want to take high risk and get high returns. I said, only thing certain with high risk is high risk of losses, high returns are not guaranteed. And the other was that, no, we don't have extraordinary expectations. We'll be happy if you give us 30-35% compounded.
Wow.
When you are in that mode is when you should probably look at cutting back. And sentiment is always a contraindicator. Again, studies around the world have shown it, not just in America, but every continent, every country, this study has been done. It shows that sentiment is a contraindicator. When there is fear, anxiety, question marks, then the next period returns are higher. And when everybody is gung-ho, the next period returns are lower. So that's how it goes.
Devina, I'll be very happy with that low to mid-teens returns. I keep my SIPs going, most of what I earn. And people say, Nigel, you didn't see 2008. I don't want to see it also, and I hope I don't have to see it. But probably this could be the best phase to build a longer-term portfolio. So that's my hope.
Absolutely. Devina, you said it, I think. That's going to be the new reality check for a lot of newer investors. I'm hearing that in some of my friend circle as well. Market doesn't go up. And the idea of, 12% returns compounding being good returns, that idea is very alien and very new to a lot of the youngsters who came to the market post-COVID, right? But we'll see. The market is the best teacher, they say. And I'm sure people will learn.
They say you are smart if you learn from other people's mistakes. But at least learn from your own mistakes.
Absolutely, absolutely, Devina. Great chat. Thank you so much for joining in. You have a great Friday, and we'll connect again soon. Well, we're staying with the market. By the way, it's about a 380-point up move right now. It's a nice market in cruise control mode, at least right now. 22,770 on the screen. Nilesh Shah is with us from Envision Capital, of course, to get some more perspective in. Nilesh, it's dizzying, it's crazy, it's up one day, it's down another. Within one night itself, it's, so many different cycles. But my question is that now that there is this 90-day pause, and we know his mind has shifted, he's understood that you can't completely destroy markets, Mr. Trump. Do you think we're past the worst?
It's hard to say we've passed the worst because clearly there's so much of volatility. Every day, decisions come, new decisions come, previous decisions change. So till we do not get to a stage where countries sign up on these bilateral trade agreements, it's always going to be hard to kind of really say whether the worst is behind us. But I'd at least say that the kind of uncertainty which has unfolded in the last few days, and the fact that the markets have already kind of been on a consolidation or a correction mode for almost now more than 6 months, I'd say that a fair bit of the damage is already done. I mean, I haven't seen the sentiment as bad and so many words of caution coming in versus what we have heard in the last maybe 3 to 4 years. So to that extent, I'd say a fair bit of the damage is done. In fact, maybe investors run the risk that if there is basically a final settlement to this chaos, you're going to be caught off guard. So clearly, I believe that a fair bit of the damage is done. Valuations are turning attractive. It's just more now getting into more of the bottom-up mode to kind of build a more long-term portfolio. So I'd say that, yes, a fair bit of the uncertainty is behind us, but you can never say that it's entirely over.
Sure. Nilesh, so one specific question on IT services companies, and we've discussed this in the past. You're obviously very bullish on digital and internet businesses, but traditional IT services, I mean, look at TCS. I'm not getting into what they did in Q4 or not, and Q4 was their worst quarter in FY25. But even if you look at backdated numbers, in FY23, the company, this was just after COVID, company, came off 13-14% kind of growth. FY24, TCS grew at 3.5%. You can argue there was base effect over there. This year, it's ending with a growth of 4%, minus any tariff or global uncertainty. How should investors look at the IT exposure they already have in their portfolio?
So if you're not a benchmark indexed investor, you're not hugging the benchmark, then there's actually no reason for somebody to be in the large cap IT space.
And this is not just a recent phenomena, but clearly with the huge base effect, even if I were to kind of look at it for a very long period of time, when the US has been on a roll, technology spending has been quite phenomenal. Our large IT services companies have probably been growing in mid to high single digit, at best 10% in local currency. So if you actually remove the currency depreciation, the growth is even lower. So clearly, these are businesses which probably have been growing at about 5%. And you kind of mentioned that data point even for the most recent times. But I think that's true for a very large part of the last 5 to 10 years. And I don't see this changing meaningfully unless any of these companies do a very big pivot. And I think they've now grown just too big that I think it's going to be very difficult for them to do a mega pivot. So to that extent, unless you are a benchmark kind of oriented investor, honestly, I think within the world of IT services, there are many more other bottom-up opportunities in the tier 2, tier 3 space, which are doing some really specialized work. So that should really be the focus segment. I would probably think of the large cap IT to be more like kind of a value play, where you suddenly see it too beaten down, you want to participate in the market, maybe at some point of time it becomes a good value play to kind of buy into and maybe hold it for the next 6 to 12 months and see stock prices go up and you exit out there. But beyond that, these are single-digit growth businesses. Of course, these are fabulous companies, the kind of capital efficiency they deliver. So they are great companies, but probably not great investments.
Absolutely, and I think I put it right there. Nilesh, hi, morning. Talk to us about one or two bottom-up ideas. You know, it's been so much macro last few days. But it's at the end of the day, if you're going to make money, you've got to buy some stocks, right? And I think it'll be helpful for our viewers if you can. Just, of course, with full disclosure. Yeah.
Yeah, without getting into individual names, but clearly, Prashant, I think the 2 or 3 opportunities where I'm still kind of extremely excited about, and they've got nothing to do with a global slowdown or a global recession or anything to do with tariffs, but clearly, one is the whole digital space, and there are plenty of fintechs out there. There are some of these consumer internet companies, which I think continue to kind of do well. No matter how much of bashing that we do around food delivery or quick commerce, but this is really probably the fastest growing segment that we have in India. Clearly, payments is again a very, very exciting opportunity. Clearly, where the whole...
I think Fino payment is... I mean, if you allow me, is that name? Which you like? I mean, you already own it.
What we own are both Fino Payment Bank and Paytm. These are the 2 companies that we own. One is a bank, the other is essentially a payment platform, but getting into essentially a whole range of financial services. These are 2 businesses that we have been owning for some time, and we continue to really like their long-term prospects. And these stocks prices have corrected meaningfully, without any kind of an impact from a US slowdown or this whole tariffs thing. So they're clearly domestic-driven opportunities where penetration levels are low and the growth potential is quite massive over a medium to long-term horizon. So these are some of the spaces that we like.
Just very quickly, a follow-up on payments, Nilesh. You would have seen this, right? One of the regulatory issues that came out from the monetary policy was finally RBI saying that maybe we should have MDR for UPI transactions now, at least large UPI transactions. They're still, I think, considering it. They'll figure it out and decide how it needs to be shared between NPCI, merchants, etc. But could that be a big kicker for a stock like Paytm, or do you think it will be only marginal at the periphery?
No, it will be a very big kicker. It will be a very, very big kicker. And the company had also been guiding that they would turn EBITDA positive in the quarter gone by, and maybe at some point of time, they would also turn basically positive at the net earnings level. And I think clearly one of the things that will drive that will be basically the ability to charge MDR to large merchants. And that's going to be massive, because currently it's not that through other modes of payment, the merchants don't pay MDR. They do pay MDR for credit card transactions, and those numbers are quite meaningful, quite significant. So anybody who has a business which is relevant for merchants, and especially for millions of merchants, I think that's a big kind of an opportunity. The other essentially is the optionality that they sit on, that when you are serving payment products to millions of merchants, you essentially can cross-sell many other financial services products. and a start has already been made in that direction. But basically, there is a significant optionality that is sitting out there. So these are the kind of businesses which I would probably think are relatively immune to the current, the not so favorable external environment.
All right. Hi, Nilesh. Good to see you. And as always, Nilesh, for this week itself, the FMCG/consumption pack has made a comeback. And normally in times of uncertainty, the FMCG/consumption index has done better, barring this time around, because in the last 7 to 8 months, it's actually underperformed what the Nifty has done. What's your view on this sector? Because it's got some tailwinds. Commodities have crashed, so packaging cost will come down. Demand is expected to come back because Indians will have a high amount of disposable income. So that's the hope out there. And at least as of the recent predictions, the forecast suggests that the monsoon is going to be pretty okay. Your view on this theme?
Clearly, consumer is likely to outperform. I think it's very well poised to outperform. I clearly believe the roots of that were laid out on the 1st of February when, the massive tax exemptions were extended to India's growing middle class. So clearly that was the first trigger. And second is now basically the crash of crude. Clearly augurs very well for them. That's going to help them to expand gross margins and the operating margins as well. And that's been a space which is not done so well in the last few years. So I think it's poised for a fair bit of outperformance. And the trick is going to be to essentially identify select categories. I mean, of course, there's a broad consumer staples as a category, and businesses around soaps and maybe shampoos probably are relatively more mature and are highly penetrated. But some of the other emerging categories like beauty, personal care, feminine hygiene, dairy products, that's really a segment which is still very, very, early in terms of the penetration. And those are the kind of categories which will witness significant acceleration in the years ahead as India grows and as the average Indian becomes more aspirational. So clearly, consumer as a space is poised for some really decent outperformance.
So, Nilesh, what's the final advice? I mean, if we talk about, okay, let's say the next 12 months, right? 12 months, how much do you see the market rising? And let's not take Nifty 50, let's broaden the scope, even if it's a Nifty 100, but at a broader, index level, what do you see ahead next 12 months?
At the cost of going wrong, Surbi, but I would think that basically the markets would be higher from where we are today. I clearly believe over the next 12 months, a lot of this dust would have settled. I would expect, the government of India and the policy makers to unleash the next round of reforms. Third, inflation is trending lower. Interest rates would essentially be lower. And some of the most recent policy initiatives will begin to play out over the next 1 year. So I clearly think, and on top of that, I expect foreign investors to come back, given the kind of headwinds that they see in the United States. I would see increased allocation for emerging markets, including for India. So I think on the whole, be it fundamentals, be it liquidity, or be it sentiment, a combination of these three things, based on that, I would expect the markets to be higher a year from now versus where we are today.
All right, and Nilesh, on that positive note, we'll leave it here for now. Thank you very much for coming on this morning, talking markets and what you like in the markets at this point. We take a quick commercial break here. A very interesting and special conversation with Najib Shah coming up. He's former chairman of Central Board of Excise and Customs. Last time we spoke with him, we were in the middle of the sort of entire reciprocal tariffs bit. Actually, we spoke to him the day after the reciprocal tariffs were imposed. So what next in terms of India-US negotiations? Coming up. Welcome back. I think we're approaching the 2% mark on the Nifty, and it's looking good overall. We started with about a 1.25% gain, tentative, but things have picked up since. Now, noted American economist Jeffrey Sachs has warned India about getting closer with the US at the expense of its ties with China. He was speaking with my colleague Shireen Bhan. He said India should not be anti-China to please the US to try and get a better trade deal. Listen.
Market capitalization in 2 days, you're probably on the wrong track. The United States is on the path of wrecking the world economy once again. This is not U.S. policy. This is not congressional policy. This is not U.S. public policy. This is Donald Trump's policy. He is single-handedly wrecking the world economy. And I think the damage is going to be done before it gets undone. India really needs normal relations with China. And India should appreciate this is a great civilization, and this is a country that's going to play a huge role in the world in the 21st century. I mean, a huge role in the world on all sorts of things, on culture, on economy, on technology, on global peace. Yes, have good relations with the U.S., but don't be played by the U.S. Don't be anti-China because that makes the U.S. feel so good and speeds your agreement. It's the end of American leadership, I would say. It's the end of other countries looking to the United States as a stabilizer, as a rule-based order, although that was quite frayed already, but now no one could utter those words with regard to the United States. Similarly, China was not in any way isolationist. It was the major trade partner of probably 150 countries in the world. But China has aimed for the last decades to be a responsible participant in the international system. China now has to take a more leadership role. I think China will have to enable the renminbi to play a more international currency role. It's been very gradual, step by step, but I think it's going to have to accelerate.
Well, those are strong views, and of course, I mean, those things will play out over a long sort of period of time. Of course, Jeffrey Sachs has maintained some of those views for a while now. They're not new. But that wrecking the global economy, maybe that wrecking ball has been sort of reined in for now with that 90-day pause. We have Najib Shah, former chairman of Central Board of Excise and Customs, now joining us. Mr. Shah, thank you for joining us back on the program here. Prashant this side. We've been talking about global economy and world trade, etc. But now it's a pause which has come through. And I think Scott Bessent did mention a list of countries that the US will negotiate first. You know, there was Japan there was Korea there was India there as well, right at the end. What should India do now in terms of trade negotiations? And where is it? It's a very fluid kind of situation. But just give us what you think.
I think the Indian negotiators is in a very unenviable position because US has repeatedly now shown that it can disregard trade agreements. Canada, Mexico, South Korea, Australia are all examples. So this is one thing we need to constantly keep in mind. Having said that, the fact of the matter remains that the US market is important for very many of our exporting products. So, and mind you, any free trade agreement, if we were to get into with USA, will open up a whole host of non-tariff barriers. And in the latest USTR 2025 report, has a whole litany of grievances about India's non-tariff barriers. They have concerns about our imposing our BIS standards. They have concerns about our government procurement policy. They have concerns about our IP and host and so on and so forth, about our rates, of course. So they will be pushing for all these. Agriculture is a major area of concern for them in their non-tariff barriers. Now, are we willing to open up all these sectors? And these are sensitive sectors for us. So I personally feel going into a bilateral trade agreement, while it is a good option forward because it doesn't violate the MFN WTO principle, with a country like USA, right at this juncture will be difficult. We need to identify products. The EU has done that, identified products where it feels it can reduce its tariffs and work towards convincing US that this is the markets you wanted. We are reducing the tariffs there, and we'll take it forward from there. The bilateral trade agreement itself will follow all these things. But remember, when we reduce the tariffs, it has to be MFN. It should not be US specific. It should be across the board for imports from all countries. That is what will be advisable. The Indian Indian manufacturers have to be cognizant of that. We have to be cognizant of China coming in a big way. Again, we should not forget that China is the #1 country as far as all our safeguards and anti-dumping duties are concerned. So we should be cognizant of the impact such Chinese imports, which can follow a reduction in general duties across the board.
You wouldn't read this pullback, this pause as a bit of, it's a reprieve, right? And they're kind of pulling back from an extreme position. You started by saying Indian negotiators are in an unenviable position. But in a way, US has kind of given in. I mean, they're not saying 26% now. It's a baseline 10 and then to be negotiated. Of course, 10 is higher than where they were earlier, but you don't see it like that.
You see, when we were at 26, we were happy that we had a comparative advantage vis-a-vis our competitors. That advantage has been done away with now. We're all at 10. And Indian exporters will find it difficult to compete with Bangladesh and China, whose cost of production perhaps will be lesser than India's. Bangladesh and Vietnam, I'm sorry, not China. China, of course, has this, 125, 145, depending on what you want to look at. The comparative advantage which you thought we had has been wiped out. So while this may be a reprieve, it's not the end of the road. There's still a long way ahead. The uncertainty will be killing for the Indian exporter and the businessman. What should this pricing be? What should this costing be? And how much will the government of India be able to support in terms of whatever the drawbacks and the remission of duties, which the schemes which we have? How much can we support to make sure that the goods continue to be competitive?
Mr. Shah, the other thing is with now a full-blown trade war with China, and that obviously also can be, that there can be a thaw there, and we'll see how that pans out. But for now, it looks like, 84% tariffs, 145% tariffs, it's a full-blown trade war there. And if it kind of stays at that high level, Chinese goods need some place to go. Our Indian tariffs, you briefly said, most of our sort of, barriers are aimed at Chinese goods. Do you think across industries it's sufficiently high, or we'll need to be on guard there as well in terms of second-order impact because of US and China?
We will need to be on guard. China has historically been should I say, found to be depressing the cost of the products, which is why anti-dumping and safeguards have kicked in. So we need to be on a safeguard. When we are going to reduce our rates of duties for US as part of our bargaining chip, and I suggested that it should be uniform across all imports from all countries, then we have a situation where the Chinese goods can enter in again in a big way. Dumping can be a possibility. So we need to negotiate with China with caution. They are a big economy, obviously. Our exports to China are nothing compared to what we import from there. So we need to negotiate with China very cautiously. Again, if you remember, that was one of the reasons we stepped back from ROTTEP, the large-scale treaty agreement, which is across ASEAN countries, Australia, New Zealand, and China, simply because of the fear of what Chinese goods how they can exploit the trade agreement if such a trade agreement was there.
Got that, Mrs. Shah. Useful conversation and gives us a roadmap on how to think about these negotiations as they proceed. Really appreciate you coming on this morning on CNBC-TV18. Thank you for your time, sir. Appreciate it.
Thank you very much. Thank you.
Thank you. I think just a quick look at the market, 450 points, 22,850. And overall, it's 10:1 in favor of advances if you look at the NSE market-wide breadth. Nigel.
Well, it's a beautiful looking screen, actually, because we started off with a gain of around 270 to 80 points, and we're built on those gains. You like a market like this, but now we're approaching that crucial zone where we have resistance. That's around the 20 DMA, which is 22,900 or thereabouts. So need to keep an eye out on that. And the Nifty Bank, by the way, is at the 200 DMA, which is the other crucial mark that we're tracking out there. Let's move on though. Global uncertainty has hit crude oil prices. Crude oil globally has fallen to the lowest we've seen in the last 4 years. Is there more further downside for crude prices? We also have domestic news with the government increasing excise duty on petrol as well as diesel, but they've also gone ahead and hiked LPG cylinder prices by around 50 rupees per cylinder. To discuss all this and more, we're joined by Mr. Surana, the former CMD, HPCL, and also joined by Mr. Gaurav Moda, the partner and energy sector leader, EY, who joins us. Hi, gentlemen. Good morning, and thanks a lot for joining in. Well, Mr. Surana, let me come across to you first. The oil minister says that OMCs normally carry inventory for around 45 days or thereabouts. The question is, maybe by May, should we be bracing for a price cut in petrol as well as diesel?
Good morning to you and Mr. Gaurav and all of your viewers.
Morning.
So there are three aspects which we need to consider before we reach to this judgment that after the inventories are over, whether we should expect another price cut or something like that. If you remember the past discussion which we had and the past narration, there are under recoveries on some products. There are over recoveries and under recoveries simultaneously happening at different points of time in some products. One may try to infer that there is a cross-subsidization of products. Probably that is right. But India is a heterogeneous country and there is no one-fit solution to that effect. The increase in the excise duty or increase in the LPG price, while it may look an antithesis on the first glance, but it looks perfectly logical because the volume share of the different products, let's say MS, HSD and LPG, is not the same among all the market players. There are some companies who are not in the LPG business, but they have the MS, HSD volumes. So we can't have a situation where there is somebody who is a beneficiary of the margins, higher margins on some products, and some companies only are bearing the under recoveries on the LPG. So the way the government has thought of increasing the excise duty and not passing on to the consumer, it's a smart solution in my opinion, which has got something for all the three stakeholders, that is the consumer, the companies, and the government. Now, it also solves one issue that because we are incidentally in the April month and any downward revision in the price would have led to inventory losses also. So that solves that problem also without allowing the companies to continue to retain the higher margins on these two products. Now, come May, whether it should be reduced, it will depend on two things. One thing is the base objective of covering the under recoveries, which the minister has said that 41,338 crores, whether that has been reasonably reduced, number one. Second, how the oil prices and the product prices behave in the international market, because all said and done, the prices have not been aligned to the international markets over the last few years. So these two components should decide. And the third part will be that the OPEC's move on the crude prices, because as we have seen, they have accelerated the rollback of the voluntary production cuts, which they have done earlier, and almost what the production should have come in July has come. But also then we should expect that the prices should be heading downwards.
You expect globally crude oil prices to head further south?
Yes, I would say that. Of course, it did touch 60.89, I think the lowest thing, and has come back to 63 point something today morning. But I think I don't expect it to go beyond 7. So the base, which was in the range of 75 to 80 earlier, I think it is shifted to now 65 to 70 or 60 to $70 in the near future. And that can be seen with the market structure of the derivative market, where in the Q2 and Q3 of 2025, we see a reasonably supplied market.
Okay, all right. Just to clarify, sir, you said that, it's perfectly logical what the government has done. That's hiking their excise duty as well as hiking the LPG prices as well. Do you expect another price increase on LPG? And do you expect them to deregulate it?
If you would have heard the minister's press conference, he did mention that from July 23 to February 25, I think there is a 63% increase in the international prices. So as of today, this 50 rupees increase is not covering the under recoveries which are there as of today. So even now, there are continuing under recoveries. That 41,338 crore was the past under recoveries which has got accumulated. Now so this increase will cater to part of that under recoveries for the phase which we are going in. But still you will have some more under recoveries coming in. But it is a reasonable solution where the 2 rupees increase on MSHSD, where the margins are reasonable. That covers, I was told that 32,000 crore or so in the will mock up, and 4,000 to I think 6,000 will come by LPG. But we still have got some component of the LPG under recovery which is ongoing because it is not covering the full market price.
Okay. All right, Mr. Surana, coming back to you, I want to ask you about Delhi's EV policy as well and what that could spell for the industry. But let's get in Mr. Gaurav into the discussion. Hi, Gaurav. Thanks a lot for joining in. Well, a lot of moving parts. Give us your take first, based on what's going on in the globe and also the government action.
Sure. I mean, very simplistically, as Mr. Surana has also mentioned, the global crude prices, which were averaging $75 to $80 per barrel, are now in the lower 60 range. So there's a 20% drop on averages. And this is reflected in the Indian crude basket as well, as we buy from Globe. So 20% drop is good for India, given we import almost 80%. But what that also means is some of this is to be passed to the consumers who've been bearing 90 rupees, 100 rupees per liter of petrol and diesel. At the same point of time, if you look at the back end, which is the refineries, and majority of the refineries happens in India, they will be under cost pressure. And therefore, cost optimization programs may get started to improve refinery margins as the crude prices come down. So it's a double-edged sword as far as the Indian oil sector is concerned. Good for the consumers, but the players need to see how they make money out of this.
Okay, all right. Mr. Surana, what do you make with regard to the New Delhi EV policy that they laid out? IGL is the one that gets most impacted because of the exposure they have to Delhi. Do you think they can go the distance and implement it?
The policy is still right now at the draft stage, so it needs an approval. And the Delhi narration of the pollution, I think, is slightly different than the whole of the country. So we cannot implement the similar solution all over India. But considering all the noises which we hear about the Delhi pollution and which comes every summer season, so targeting the two-wheelers and three-wheelers towards the EV, which is easier to do than the four-wheelers part, I think this may be one of the solution. But and because it is more towards the last-end connectivity of two-wheeler, three-wheelers. So this is a move in the right directions. Now, to what extent it gets implemented and how quickly it gets implemented, we need to see, because what is being said is that the new two-wheelers will not get registered about after 15th August 2026, which are not EV, and the three-wheelers beyond 15th August 2026. And there is a plan to, over a period, phase out the CNG run and petrol run and diesel run two-wheelers and three-wheelers.
Okay.
So let's see how what fashion it comes ultimately. And
got it. Okay, all right, Mr. Surana, before we let you go, I wanted Gaurav's opinion as well. What do we see next? Another hike in excise duty from the government on petrol as well as diesel? Or do we brace for a cut? Because that will be of interest, not just to the shareholders, but also to the common man. Gaurav?
Yeah, I think before that, just a quick perspective on the EV view. If you look at the total transportation fuel in the country, almost 50% of that is diesel, 20% is petrol. Now you're looking at most of the EV impacting the 20%, where almost more than half of it is two-wheelers and less than half is four-wheelers. Effectively, all the conversation we're having on EV is on the 20% bracket, and within that on two-wheelers, which is 12% of the overall transportation fuel. 50% of transportation still sits on the trucks, and majority of that is the large trucks flying on highways. Unless we come up with a solution on the diesel side, which potentially may be hydrogen fuel cell in distant future, EVs will have a certain impact within the city, but not beyond a point.
Okay, all right. And you want to give me the answer to the other question that I asked you? With regard to what do we expect, excise duty hike or a petrol price cut?
Difficult to comment on that, on government policy. But the government has shown in the last 8 to 10 years that they want to keep the market stable, and therefore sometimes excise cut to manage price hike versus excise increase to manage crude oil prices coming down is the balance that government needs to maintain. Overall, a 20% decrease in global prices should reflect somewhere to some extent. In fact, even if you look at the global forecasts for crude for the next 18 months, it's downwards. So somewhere it'll reflect. How much we'll have to see, how to best balance.
Okay, all right. Thanks a lot, gentlemen, for joining in and giving us your perspective. Wishing you all a good day ahead, and we look forward to chatting up with you all again on the show as the entire situation does evolve globally as well. Wishing you all a good day ahead. Well, the markets are holding well in the green, 450 points. No worries on that front. The breadth of the market as well is as good. So it's a good start. It's a good Friday morning. And when we started off this week, the fear was of that Black Monday. Well, that's not really taken place. And in fact, we could possibly end the week more or less flattish, which will be a good outcome. Let's focus on a couple of stocks. Vinny's here to tell us about the pharma names, Sun Pharma as well as Cipla. Vinny, take it away.
Hi, good morning. So Sun Pharma, we've seen that it's opened up in a green, holding on to some positive side. Why? Because now it has got a positive news flow coming in for the Lexelvi drug. There was some court case that was going on. U.S. Court of Appeals for Federal Circuit has ruled in favor of the company. So the preliminary injunction, this was there, that has been lifted. So now they can launch this drug. Yes, the court case is still going on, but they can launch the product coming in. The company had mentioned also in its con call last time that these could see a launch coming in as soon as they win this. There would be a launch in the next 2 to 4 weeks. So yes, we could expect that coming in the next month or so. Now, obviously, do not forget the patent for this drug is ending in December 2026. Analysts are highlighting that this is a very big positive for Sun Pharma. $400 to $500 million sale is what one could expect from this drug as a peak sale coming in, and EBITDA of around 50%. So very positive news flow coming in for Sun Pharma. Other one, Cipla, that's a positive news flow as well. They've received a US FDA approval for generic Abraxane for their company, which is used for the treatment of breast cancer. Now, this product was expected to be launched in the second half of FY26. This is a positive surprise that has come in, given that the US FDA approval is coming now, and they will be launching the product soon, H1 FY26. Now, Elara has also already penciled in a $20 million revenue for this in FY26. Currently, there are 4 other players, 3-4 other players who are there in this as well, but a big positive for Cipla on this front as well.
All right. Thank you very much for that, Vinny. Muthoot Finance is the stock which actually is selling off. Ritu is here with the changes the RBI has made with regards to gold financiers. Ritu, morning.
Good morning, Prashant. 98% of Muthoot's AUM is gold loans. So yes, it is one of the most impacted. But the headline from these draft rules really is they're not as bad as feared, although there may be some near-term impact. Now, what do the rules, the draft rules say? For bullet repayment consumption loans, the tenor has now been capped at 12 months. They also say gold now has to be valued at 22 carat purity. LTV changes or loan-to-value changes are some of the most significant that will impact NBFCs like Muthoot. Now, what RBI has said is that this 75% LTV has to be maintained throughout the tenor of the loan, something that was already applicable to banks, but it is now being made mandatory for NBFCs as well. The other additional factor is that the accrued interest has to be factored in when calculating that 75% LTV ratio, which means, at the time of sanctioning of a roll, you can't, the dispersal amount cannot breach that 75%, including the interest that was to accrue. So the origination LTV may actually have to be brought down lower. And if this breach in LTV continues for 30 consecutive days, there's also a 1% additional standard asset provisioning that will apply. So what it really does is reduces the arbitrage between NBFCs and banks, which is why you're seeing the likes of Muthoot getting affected. Now, brokerages say that this can affect, growth in the near term immediately after implementation. But they also say, the outcome is slightly better than expected because, for instance, markets were talking about, people in the street were talking about bullet loans itself being scrapped. Morgan Stanley believes Muthoot's countercyclical business can still ensure strong earnings, building in an ROE of 20% for this financial year, 18% for next financial year. And CLSA says this will be marginally disruptive for Muthoot and is building in a loan growth of 12 to 15% over this year and next.
All right. Thank you very much for that. The stock tag there, of course, is Manappuram. But just look at Muthoot and what that is doing. 5.5%. So it's off the lows by about 1.5%. Ritu, thank you for that. Mitesh is with us now with what he'd want you to do in terms of specific trades. Mitesh, over to you.
Yeah. Prashant, the market is quite good, and I think we're just holding on. We're not actually selling off from 22,800. So still, trading with some long buys. Grasim is something which I would recommend a buy. Keep a stop at 26.20. Look for targets of 26.80 to about 26.90. And Paytm is another one which opened a gap up and sustaining. So we'll take a very tight stop at 8.20 or just 819 here and look for a target of around 855, 860.
All right, Mitesh. Thank you for that. We'll speak again soon. Appreciate it. Well, we'll take a quick break. Back on the other side. Okay, welcome back. We've been talking about stocks and equities all day, but let's talk about commodities now. And of course, gold is glittering once again, bouncing off very, very sharply over the last 2 days. Manisha, take it away.
Oh, well, absolutely. There are various concerns in the international markets right now. And even as the equity markets have gained today, gold is not left behind. We're looking at all-time highs coming in and continuing for the gold prices. $3,200 an ounce is a level that we've been talking about for a very long time in this year as an year-end target. But there you have it. 32.20 is what we've seen in the Asian markets, in the markets today itself. So with this, gold is on track on best weekly gains since November 2024. And we also have seen gold prices hit all-time highs, not just in the US dollar terms, but in the Indian rupees, where we are trading above 92,000 rupees. Gold is also trading at an all-time high in Japanese yen, Australian dollar, Euro, Chinese yuan, all of those currencies as well. Very strong gains continuing, and that's also on the back of the US dollar index, which is trading at a 3-year lows. That clearly has been supportive for the gold buying there. The markets also are looking at strong ETF investments globally. Those numbers have continuously seen inflows for the last couple of quarters, and April has started no different, and that has been supportive. Well, the markets are looking at escalating US and China trade tensions with various tariff missiles being thrown on both the countries, and that has been bothering. Tariffs on China is now 145%, and China tariffs on US now stand at 84%. There have been various calculations from various sectors on what it would really mean in sense of businesses between US and China, where the costs have gone up really high. So the inflation concerns has been one of the reasons that we've seen gold prices continue to do quite well there. Well, there are bullish cues coming in from the US markets itself. The US March CPI data that came in yesterday has been on the lower side, pushing for a rate cut as early as for the month of June itself. And then it also has been about the high US national debt. $34 trillion is what we saw passing in the month of November itself as an all-time high, and it only has grown since then. That has been supportive. The markets also are looking at COMEX gold holdings, which are also near record highs. The markets have been buying ahead for eventuality like this one. So strong buying continuing on physical markets and investment buying as well. The next chart should tell you on what the global banks and brokerages now believe that the gold prices can go up to. Well, 3,000 almost done, 3,015 also done. Deutsche Bank has talked about 3,140. And in extreme scenarios, they've talked about 3,700 on the higher side as well. That's going to be a level to watch out for. 3,200, again, we are standing at those levels as being put by ANZ and UBS. Remember, these banks had put these targets for the second quarter or the second half of this year. We already have seen that happen. Now the higher targets. Goldman Sachs has talked about 3,300 and 3,350 is what Bank of America is talking about. Citi says if investment continues stronger and there are extreme chances, you could be looking at 3,500 into this year as well. De Beer has talked about 3,300 and an eventuality can take the prices to 4,500 on the higher side. And this, the last one, is the most bullish of all until now. This comes in from Swiss Asia, where they say they're anticipating gold prices to continue to gain in the next 2 to 3 and 4 and 5 years as well. They have a gold target of $8,000 an ounce until 2028. Well, so everywhere that you look, we have banks revising their gold targets on the higher side, and it continues to be very, very bullish.
You know, Manisha, $8,000, we're at 3,000, right? 3,000 to 8,000 in 3 years.
Yes.
That is almost a 40% CAGR return, 40% compounded.
And if you look at the last 1 year, it's gained up by 40%, Prashant. So we've seen gold prices gain up by 40% in 1 year. This is about 3 years of a target. So,
absolutely. And, you know, we'll see. But it is absolutely the go-to in that sense, a safe haven and so many other reasons why gold's been doing well. Time for a quick commercial break here. We're going to come back, special segment. It's the economy. Latha in conversation with Brian Colton, Chief Economist of Fitch Ratings. We discuss what else, but Trump tariffs, the pullback, the pause, coming up.